Hello and welcome to Big Deal. I'm Nisha Poddar. Now, the equity markets in India have shown immense resilience despite the weak macro data globally and has opened a window of opportunity for many equity deals on the bourses. In fact, private equity-led block deals in particular have been the trend in recent times. But what does this really mean for the broader equity market deals, and are these sustainable levels? Let's find out from our team of experts joining us on the show, Vivek Gupta of KPMG India and Salil Pitale of Axis Capital. Thank you so much, gentlemen, for joining us. Now, both of you are deal makers, have the pulse of the markets. Salil, let me begin with you. What's your view on the deal street with this equity market window really presenting itself? Has this really infused confidence for more transactions while the deal flow has been on a slow lane?
No, I think so, Nisha. Markets, the deal street is coming off a few months, 7-8 months of very tough periods, wherein we would have seen that, there's been a lot of FIF capital flow out of the country. It's reversed in the last month or so. And the quality of the names that are coming in is also telling us that, it's some good quality set who are participating in the deal activity. The domestics have always been there, who held fort in this last 8 months when the FIs were in the sell mode. So I think both the fact that, foreign money and good long only quality money coming in, domestics holding fort, retail HNI looking stronger, means that I think deal activity, at least right now, is definitely there. It has to be carefully calibrated. It's not that every deal goes through. People are looking at valuations in the current context and not necessarily the euphoric valuations in some cases earlier on. But one would tend to believe that there is a fair amount of action on the ground. Yes. We as bankers are engaged with a lot of players right now to see which of them hit the markets. And you would have seen in the recent past, there's a fair amount of block deal activity. There's some activity on the QIP side. There have been 3-4 IPOs which have gone through. There's some of these stuff still lined up. So we are quite enthused. We think this is a market window which is opened up. There would be some deal opportunities which will still go ahead.
That's right. For corporate finance, also for the companies, it is providing a lifeline in an interest rate hardening scenario. But Vivek, let me get you into the discussion. What is the kind of action on the ground that you're viewing? And do you think this momentum is sustainable?
So look, there are two parts to this. I completely agree with Salil to say that the last month has been very different from the scene, let's say, from November of last year. So from November of last year, there was a very discernible change in the markets in that companies that were earlier thinking of IPO plans had to either defer or shelve their IPO plans just because the market was not supportive. The last month has seen market activity. I also agree with you. At the top of the show, you made the comment to say a lot of secondaries have happened, particularly on stocks that were coming out of their lock-ins and so on and so forth. Quality names have come in. So that part, I definitely see as positive. Will I interpret this to say, though, that primary market is back? It depends on how you define it. Quality assets at reasonable valuations, certainly primary market is back. However, in a scenario where money is not going to be globally as easy as it was, let's say, during the COVID times when really the monetary policies meant that money flow was very easy, I do think that the scope of the equity market window will be more calibrated. Investors will be more careful, and the kind of assets that will be able to access the primary markets, at least, they will need to show, let's say, a higher threshold than we were seeing in let's say, the last 2 years. So okay. I'm optimistic, though cautiously so.
All right. So one point I'll make is that a lot of deals had gone out of the market also because of the froth and the impending headwinds on the macro side. So Salil, valuations have a big role to play in deal making, and you can reflect and throw more light on that particular bit. Some froth was out of the market. Now we are again seeing enough volatility. Instead of saying euphoria, I would say call it volatility because it is still tentative on a day-to-day basis. How do you put together all these factors fitting in for the future trend of deal flow?
So let's put it this way. From the valuations point of view, the world has changed, and therefore, price points and market multiples have changed. What they were, let's say, 12 months down the behind us versus now are different. The sectors which could be of interest also change a little bit in this. You mentioned about froth. Yeah, I think there was a concern that a lot of, especially tech related areas wherein, valuations seem to be pretty large at that point of time. They were then reflective of what global markets were looking at, especially NASDAQ and the likes. There's been serious correction out there, so that correction is not lost on India too. And, for, some of the tech related companies, that correction is reflected in traded prices today, as well as increased interest, if at all. The type of interest has changed. Let's say in tech side, what we do perceive now is a lot more focus on, even within the tech, the quality names with either profitability or a decent path to profitability. Those are of sure interest. Among the other sectors, there's a whole set of sectors which have also started becoming, important beneficiaries in the marketplace today. And the whole manufacturing related area is of tremendous interest. And there people are willing to pay strong price points because they see that the runway for growth is very good. So I would think, valuations, the froth on tech reduced, a lot of discerning stuff.
Yes.
But I think the interest is, it goes into stuff like manufacturing, a lot of financials, electronic design, chemicals, those are the areas which are seeing good quality interest now.
All right. So those are the sectors which are more in vogue right now. Now, Vivek, Salil mentioned about the startup IPOs and the valuations, the deal making there. Do you think that the equity markets in this tentative phase is going to give another chance to startup IPOs at all, even if valuations have come down? And in the promoter founder mindset, have the valuations really dipped now?
Okay, so 2 points to make. A, I think access to globally as interest rates harden, access of the equity markets to more pools of capital goes down because capital flows into other asset classes. So that is one thing to bear in mind. Two, that having been said, I wouldn't call it so much the startup versus the non-startup community. I would simply say the bar for proving yourself to be a worthy candidate on the exchange has gone up. In other words, earlier the market was willing to see you as a good story, path to profitability of 5 years, 7 years, 6 years, 4 years. We've heard all kinds of stories. And so long as you had a large share of the market, that was acceptable. I do think that the market has fundamentally altered, and the current market will now perhaps not believe so much. They will want to see a shorter term, or at least a medium term path to profitability as a very inherent factor before according a chance to what you call a startup for an IPO.
Right.
So the traditional sectors, of course, but in the new age sectors, a sounder business model as demonstrated by an immediate path to profitability or a closer path to profitability, I think will be the definition of what the market is willing to accept.
Right. Path to profitability is something that we have been harping on again and again. And in the equity market euphoria that we saw last year, same time, Salil, a lot of things got passed very easily. But now the investors have also learned their lessons. The founders have also understood the public market to some extent. Another important event and milestone in the life cycle of some of these startups and unicorns which made it to the IPO market are the lock-ins getting over. We saw the entire case pan out with Zomato. From that experience and looking into Policy Bazaar as well as Paytm coming up in the next 2 months, what is your view on the acceptance and how it will go through, and in terms of investor mindset and acceptability at these rates?
So I agree with you, Nisha, that, the opening up of the lock-in, the statutory lock-in is an event which is an important event. And, companies need to, prepare for that. It's not just in a lot of such companies, shareholders are a fairly diverse set of shareholders. They could be different private equity shareholders with different investment time horizons themselves. So each one may potentially have a different way of looking at it, different entry price points and so on. So it becomes trickier. Having said that, we've also seen that the markets have, in some of these companies which have had stock coming out of lock-in, taken the lock-in stocks in their stride. We had Sona Comstar coming out, certain blocks happened in that. Even at a much larger name, somebody like an HDFC Life, where, Standard Life is a large shareholder. They have, consistently sold blocks. It's just that the interest in the name and the price point will matter. It's not just to do with the fact that, I have a date on which lock-in opens up, and therefore there has to be immense selling pressure. The holders themselves, which is typically institutional holders, including private equity, themselves are also aware that, any lock-ins, any such blocks need to be nicely placed, which means that, some amount of, discovery on potential buyers has to happen. And therefore the stock gets placed in a calibrated manner rather than, it just gets sold on the screen. Sold on the screen is where destruction happens. If it's a calibrated buying, which is, organized, the markets take it in its stride. However, as I said, it will vary case to case. It will completely be dependent on, how incoming investors see that specific opportunity. And there are enough cases wherein if the opportunities seem to be pretty good, the stocks have been resilient, even though the lock-in stock has come into the marketplace.
All right, and I'll pick your brain more on the investor mindset and the kind of investors that we've seen in the past few months, Salil. But we'll slip into a short breather on Big Deal at this point. We'll continue the conversation on ECM market window and how the deal street is going to look like going forward. Stay tuned to Big Deal.